Okay, I think all attendees have been admitted, so we can start now. Please, Keith.
Okay, good morning everyone. Welcome to our virtual research seminar for academics. For those of you that don't know me, my name's Keith Kendall and I'm the chair of the Aasb. The purpose of this morning's session is to provide an overview of the Iasb's discussion paper, business combinations, disclosures, goodwill and impairment, and give you a chance to highlight and discuss any academic literature relevant to these topics. This morning we'll have Ann Tucker, Iasb member, and Tim Craig, Iasb staff, and we have Kim Carney from the Aasb with us too. I'll now pass over to Anne, who will take us through the first part of this morning's session.
Thank you, Keith, and good morning to everybody, or good morning, good day, good evening, depending on where you are. It's a great pleasure for Tim and I to be here speaking to you again on this very important topic of goodwill, impairment, disclosures, business combinations. Firstly, before we start, some housekeeping. As with all our presentations, any views we express today are our own views and not necessarily those of the Iasb, the Ifrs Foundation, or the Aasb. Now, our plan for today is to start by giving you an overview of the discussion paper, which the Iasb published in March this year, and there is a link on the slide that you can see that would take you through to the discussion paper. We aim to present the slides for about 20 to 30 minutes in total, and we'll pause at various points during the presentation so you can ask questions on the discussion paper and offer any comments that you may have. In particular, we're interested in hearing about any academic research that you've done or that you are aware of that's relevant to the topics we're covering today. Attendees can ask questions today using the Q&A function, and we'll attempt to answer as many of these as we can during the course of the presentation. When we're doing the Q&A and answering the questions, the participant that asks the question will be taken off mute and will be able to respond to any follow-up discussion. So the Q&A function is in the taskbar at the bottom of the screen, and on mobiles, you should click on the screen to get the option. Fellow participants can like questions if you also want us to address that one. Going now to slide 3. So slide 3 gives us an overview of our project on goodwill and impairment. So the Iasb started this after post-implementation of Ifrs 3, and we published the discussion paper in March. The deadline for submitting comment letters is 31 December of 2020. And those of you who have got kids and you're already doing the Christmas countdown, you know that that's just around the corner. And many people think that this is just a project about accounting for goodwill, but in fact the objective of the project is broader. The objective is to improve the information that companies provide to users of financial statements at a reasonable cost in relation to the businesses that those companies buy. So the Iasb hopes to help users of financial statements hold management to account for those acquisition decisions. The discussion paper has a number of specific questions for stakeholders. The Iasb is particularly interested in hearing from stakeholders on how useful and feasible they think the new disclosure ideas are, as well as whether they will have any new evidence or arguments about the best way to account for goodwill. So, as you can see, this is a really important set of proposals for the Iasb, and I do encourage people to respond to the discussion paper so that we can look at your views and give them due consideration. Slide 4, please. So slide 4 summarises the preliminary views of the Iasb that are presented in the discussion paper. So the preliminary views cover 3 main areas, as you can see, and they reflect the concerns that the IASB heard from stakeholders. Firstly, the area relates to disclosures. The IASB's preliminary view is that it should propose to require companies to disclose information about how business combinations perform after the acquisition. Second area relates to improving the accounting for Goodwill. IASB explored whether it could make the impairment test more effective, but its preliminary view is that this is not feasible, so it's not feasible to improve the test significantly at a reasonable cost. The IASB then considered whether to propose reintroducing amortization of goodwill. And the IASB's preliminary view is that it should not do so, because there is no compelling evidence that to do so would significantly improve financial reporting. The IASB also explored some possible simplifications that would reduce the cost of performing the impairment test by removing the requirement to perform the test annually and amending how value in use is estimated. The third and final area shown on the slide relates to some other topics. So the IASB's preliminary view is that it should require companies to present total equity excluding goodwill on the balance sheet. The IASB also thinks it should retain the current approach of requiring companies to recognise identifiable intangible assets separately upon acquisition, rather than subsuming some of these intangible assets into goodwill. And it's worth emphasising here that the views in the discussion paper are preliminary. Depending on the feedback and comments that we receive during the outreach and events like this one today, and the comment letters, the IASB may decide to reconsider some or all of these preliminary views. Slide 5, please. So now we're going to look at these preliminary views in more detail. One of the key messages that the IASB has heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well a business combination has performed post-acquisition. So investors want this information to hold management to account for its decision to acquire those business. Most investors have told us that the information is needed for stewardship purposes to help them. So for example, to determine whether they can trust management with future capital. Now, existing standards do not specifically require companies to disclose such information, and hence any information that is provided today is disclosed voluntarily. Therefore, the discussion paper explores whether to require companies to disclose information on the subsequent performance of business combinations. The IASB's preliminary view is that it should require companies to disclose the following in the year of acquisition. Firstly, the strategic rationale for the business combination. So the rationale would be a high-level statement that links the business combination to the entity's overall strategy. This overall strategy may be set out elsewhere in the company's annual report, for example, in its management commentary. Second, the key objectives of the specific business combination, these being the more detailed aims that management intends to achieve as a result of the business combination. And thirdly, the metrics and targets that management will use to assess the extent to which the key objectives are being achieved. Then in subsequent periods, the company would discuss the business combination's actual performance based on those metrics to enable investors to assess to what extent the key objectives identified at the acquisition date are being met. Moving now to slide 6. We provide some information here about the kind of information that companies need to disclose in the subsequent years. What we've observed is there's a wide range of business combinations and they serve a wide range of purposes. So the IASB concluded that no single metric would be suitable for every business combination. The IASB is exploring a management approach. In other words, The metrics disclosed would be those that the entity's management uses internally to monitor whether the acquisition has met its objectives. These measures could be operational or financial or a mixture of both. Now, because acquisitions can involve large sums of money, the Iasb presumes that most companies are monitoring their major acquisitions. But if management is not monitoring a business combination, the Iasb believes that the company should disclose this fact rather than the Iasb prescribe a minimum set of information to be disclosed. When we say the information is being used by management, what do we mean by that? The discussion paper proposes that we use the perspective of the company's chief operating decision maker. You'll recognise that term. It relates to Ifrs 8, and it's used when we talk about the identification of disclosures for segment reporting. The main reason why the Iasb is suggesting the chief operating decision maker as the threshold in this new context is so that companies disclose the most important information about the most important business combinations. A lower threshold might result in excessive and costly disclosures, particularly for companies that make many acquisitions. However, we would like feedback on whether using chief operating decision maker as a threshold would lead companies to disclosing all the material information that investors need about the business combination. The Iasb is aware that some stakeholders have various concerns about providing this information. For example, we hear, what if the acquired business is integrated with an existing business post-acquisition? But the answer to this depends on how management is monitoring the success of the business combination. For example, the chief operating decision maker may be monitoring the performance of the business combination using information about the combined business rather than the acquired business in isolation. In that case, the company would disclose information on those metrics about the combined business that the CODM is using. The principle here is to disclose the information that management uses internally to monitor the business combination. The board's not expecting companies to create disclosure to satisfy the requirements, but to disclose the information that management is already using internally. Sometimes when we discuss the IASB's preliminary view on the subsequent performance disclosures, the issue of integration is raised. It sometimes sounds like it prevents companies from monitoring the business, and therefore, when integration occurs, management do not know how well a business combination is performing. However, when we've had the opportunity to discuss this further with stakeholders, we often find that management are still monitoring the business combination in some manner, and they are aware how well a business combination is performing, at least in the early years. And that is what the IASB expected. The discussion paper discusses other concerns that the IASB has heard, including whether the information is commercially sensitive and whether it is verifiable. So we want to explore these concerns with stakeholders, and we hope that stakeholders raising this issue will also help us find ways to address them. Because in the IASB's view, it is reasonable to ask investors, it is reasonable for investors to ask companies to provide information to help them understand better how a business combination is performing. Now, we'd like to go to slide 7. We'd like to go to slide 7, which summarises the IASB's preliminary views on some of the other targeted improvements to existing disclosures in IFRS 3. These proposals are about the information provided in the year of acquisition, which include requiring the disclosure of expected synergies, defined pension liabilities and debt assumed, as well as some changes to the actual and pro forma information disclosed about the acquiree. So you can see the details there on the slide, what we've heard from stakeholders and how we're planning to respond. So what we'd like to do now is we'd like to open up the session for your comments and questions on these preliminary views. We would like to use the Q&A that you can find at the bottom of your screen. We'd also like to hear about any academic research that you're aware of that you think is relevant to this topic. So I'll hand back to Kim and we'll begin with the Q&A.
Thanks, Anne. So while attendees are having a chance to type through any questions, we have one question here from Peter. And Tim, I will pose this question to you. So Peter has asked a question about whether impairment testing might be made more effective if entities were, for example, required to disclose the assumptions used by management where there was an indicator of impairment, but ultimately no impairment loss was recognised. So Tim, I pose that question to you, and Peter, I'm just going to unmute you so that you can elaborate further if required.
Yeah, so I mean, we might pick up a little bit of this, as Peter says, later on in the session. I mean, there are already requirements in IAS 36 to disclose the assumptions that management and companies make when doing annual impairment tests of cash generating units, including goodwill. One of the issues with moving to an indicator-based test, and I'm not sure whether this is really focusing on the board's preliminary view of moving to an indicator-based test, is that some of those disclosures wouldn't be provided. Now, the board has yet to think about the disclosures it would potentially require if we did move to an indicator-based test. It's waiting to hear what feedback is from stakeholders, our preliminary view of to move to an indicator-based impairment test. And then in the second phase, if the board decides to continue to pursue an indicator-based test, it will think about the actual disclosure requirements associated with an indicator-based test, and as you suggest there, you know, when there's no impairment but there are indicators of an impairment, and therefore a company performed an impairment test, you know, it would be useful to obviously provide information around about the assumptions associated with that impairment test, and that's something the board can look at when it decides what disclosure requirements should go hand in hand with an indicator-based test. But as I said at the start, I mean, at the moment, there are assumptions that are required to be entities perform their annual impairment test. And the reason is exactly the reason that you talk about in your question. It's to give investors and users financial statements insight into those assumptions and to assess for themselves whether they think the impairment tests and the assumptions made in tests are reliable.
If I could just do a clarification on where this question is coming from. If you look at papers like Bond et al., which looked at asset impairments, there were of the sample firms where there was a book value greater than the market value of equity. In most studies which look at this context, you find less than half the firms are actually recognising asset impairments and not making disclosures. And it's these half of the firms that aren't recognising impairments which appear to be where the most information uncertainty, and that's another paper by Sneer-Vanza, Anna Wright and myself. And what we found was that for these firms not recognising impairment, that's where all of the interest was. So, so the real problem isn't the firms that recognise impairments, it's the firms that don't recognise the impairments. And that's why I don't see this as being an issue on whether you move to an indicator-based test of impairment, but it's just purely a disclosure issue, and disclosure for firms who don't recognise an impairment. And if they have to go to confession on it, then maybe they're going to be a lot more careful about it. If I could use as an example, Myer, which is always good for asset impairment, their record on recognising asset impairment is a bit marginal from time to time, and ASIC would agree. And one of the things that emerged when they actually did make an impairment, a small one, was that they were still showing a sales growth rate assumption of 2.5%, which was just rubbish. And if they'd disclosed that earlier, people would have realised realised how rubbish their assumptions were.
I guess the comment I'd make is that, as I said, in IAS 36, there are already requirements. This is not just when an impairment is recognised, but certainly for where impairment tests are being performed for cash generating units containing goodwill, then management have to, even when there's no impairment, have to disclose the key assumptions associated with their cash flow estimates. And so are you saying that in the cases that the academic study is looking at, that those disclosures are not being provided?
If there's not an impairment, no, they're not being provided.
Okay, I mean that sounds like more of an application issue, because from my perspective, those types of assumptions, for example, IAS 36 says each key assumption. Well, this is where the recoverable amount is based on use, but each key assumption on which management has based its cash flow projections for the period by the most recent budgets and forecasts. Key assumptions are those to which the unit's recoverable amount is the most sensitive, and
that's where there is an impairment.
And that's when whether there's an impairment or not. I mean, it is when the amount of goodwill is significant in comparison with the entity's total carrying amount of goodwill or intangible assets. So whether that criteria is causing the information not to be disclosed, possibly.
Okay, thanks for that, Tim. And we have a question here from Dean, and Dean's question is, does the Iasb intend to define the term synergies, as it's reasonable to expect firms to quantify the expected amount of synergies at acquisition date if there's no, I guess, definition or consistency in what that term may mean?
Thanks, Kim. Thanks, Dean. Thanks for your question. No, I don't believe we're trying to define the term synergies. I'll defer to Tim on that in just a moment, but I don't believe the board's trying to define the term synergies, and we're relying on common practice that people have been doing and people's general understanding of what the synergies are. What we are recognising here in this area is that people have different motivations for what they're doing and different approaches to it. There's a lot of diversity. So the more that we try to be specific and require specific things, the more likely we are to miss other parts of useful information. So as always with principle-based standards, we're trying to approach this and draw out the information that will be useful, but allowing the firms, the entities themselves, to choose what it is that is useful. So under IFRS 3 currently, the company needs to provide a qualitative description of the factors that make up goodwill. So we're building on that, and we want to enhance these disclosure requirements, and we're suggesting that there is an amount or a range of synergies that are expected. So when you say, are we, is it reasonable to expect firms to quantify what they're actually doing? Are they quantifying it themselves? And we are saying that they might choose to put it in some sort of range or proportion, rather than giving a number that they might feel is too uncertain for public disclosure, but give us some sort of indication based on some sort of metric that is suitable for this purpose. And in our discussions with entities, we do believe that it is possible for them to do it. So it's an assessment at the acquisition date of what the basis of the decision that is being made. So in various conversations that we've had, we've said it's not about forward-looking information per se, it's about management's view at the time of what they're expecting in terms of those synergies. and as we said in the presentation, information to help the investors better understand what the management thought was happening when they made the acquisition, and then something to benchmark it against as they go forward. Now, we've also heard that in cases, it's not about the synergies, and they're making these acquisitions, and it's not about expected synergies. So in that case, in that situation, we would expect that they would state that, and they then don't have information to disclose, and they would say that. Okay, I'll just defer to Tim for a moment. Tim, am I right about we haven't looked at defining synergies? Am I right on that point?
Yes, yeah, that's right. There hasn't been a specific definition of that. And some stakeholders have said that if the board does go down this route and require disclosure of expected synergies, that maybe the board should give some guidance as to what it actually means by synergies and definitions. But yes, the board hasn't yet thought about that issue.
Okay, thanks, Tim. Dean, do you want to add anything before we go to the next question?
I don't know. That's fine. Thanks, Ian and Tim, for your response.
Okay, thanks, Dean.
Thanks very much. So Tim, the next question we have is from Stephen Taylor, and his question is around whether the Iasb is giving consideration to how commonly information such as expected synergies as distinct from realised synergies are fundamentally proprietary information, and the interaction between that and potential and academic research.
Yes, so yeah, the first part of the question is around, as you say, the synergies and whether it's proprietary information. So is it commercially sensitive? And certainly, commercial sensitivity is a concern that we've heard in outreach events on the board's proposals. And synergies is one of the parts of the disclosure which some stakeholders say would be commercially sensitive. I think for synergies, but also for other aspects of the subsequent performance disclosure, what the board wants to hear from stakeholders who think it could be commercially sensitive is why is that information commercially sensitive? How is that information commercially sensitive? What sort of competitive harm could it incur? Because investors say that quite often companies provide quite a lot of information at the time of the acquisition, in press releases or investor presentations that describe the strategic rationale, the objectives, and provide some detailed targets quite often, earnings accretion, synergy targets, and investors say, well, all we want is follow up to that information, and how can that be commercially sensitive? Because the company was willing to provide that information initially, and some investors say, well, we're not expecting, because quite often this information becomes commercially sensitive when you go down to a level of detail and a level of granularity. And investors say, well, we're not necessarily expecting a vast degree of detail and granularity about some of this information. We're just looking at what are the targets that management are aiming for in terms of the objectives of an acquisition, and how are they performing against those targets. So synergies, for example, some people say, well, cost synergies can be sensitive because it's talking about maybe redundancies and so on. I'm not sure the board is necessarily looking for precise details of redundancy information here. So some quite useful information can still be without having to go into that kind of detail. But the board is looking for feedback from stakeholders on this issue, because it is an issue that's quite frequently mentioned, and as I say, to get some understanding of why stakeholders think this information could be commercially sensitive and why they think they have to disclose this information. It's the information that the board is looking for. The other aspect of the question is sort of talking about that you say that the Iasb maybe is overstepping the role of disclosure as a source of clarification or justification of measurement and recognition decisions, and why is the board looking at this type of information? I mean, certainly in the subsequent performance, the reason why the board is trying to address that issue, because it is heard from investors that they're not getting that information today, and investors do want that information for, as Anne explained, for stewardship purposes, to hold management to account. You know, management has spent large amounts of capital making acquisitions, and investors feel that they need information to allow them to hold management to account, and the subsequent performance disclosures is helping them to do that. And in terms of expected synergies, well, that's one of the benefits that management are expecting from a business combination, and that's addressing basically the requirement to provide information to investors to allow them to understand exactly what a company has actually acquired, to understand what the acquisition comprises of, and what management expect the benefits of that acquisition are, to help them to assess whether the price that a company has paid for a target is reasonable in that investor's perspective, and if expected synergies are a material benefit that management expect from a business combination, and that's to provide that type of information. I'm not sure whether that addresses all your points, Stephen.
Look, I think it's a pretty good attempt at addressing them. Just to put my comments in perspective, I mean, I hate to sound like a broken record, but because this is the second time I feel like I've raised the same issue, because it follows through from the proposals around the reporting of non-GAAP income measures. You know, I am concerned at what I see as a bit of overreach. Personally, I was delighted that the discussion paper advocated maintaining impairment testing, and in fact trying to make a number of pragmatic suggestions to get that to work better, rather than reverting to some arbitrary amortization rule for goodwill. And, you know, that to me would seem to be a logical outcome based on the IASB's own conceptual framework. So I can understand the measurement and recognition suggestions in the discussion paper. But when we move to the disclosure, these what seem to me to be largely ad hoc disclosure requirements, I can see no real, I mean, I understand the role of disclosure rules in accounting standards, specifically around helping the user of the accounting information gain a suitable understanding of the issues behind the recognition and measurement decisions that management has to make in preparing the accounts. But it seems to me that and that's what I see as as the role of accounting standards. When you get to something like paragraph 216C, it seems to me that it's becoming a management accountability standards board. Now, there are many mechanisms through which management are held, sometimes perhaps not held, accountable for their investment decisions, and acquisitions are only one part of the investment decision set that management face, and which ultimately is approved by the board and are accountable to shareholders for oversight and approval of those decisions. At least in Western economies, that's the sort of standard governance and accountability structure. So what I see really lacking in this, rather than sort of continue an argument about, you know, whether some of these disclosure suggestions are arguably a little naive in terms of what we would actually get from corporates, what I'll press instead is that I see no attempt to derive these disclosure recommendations from any sort of coherent framework, unlike the way in which I can understand a defence of the recognition and measurement suggestions. And that absence is what I would argue is my red flag to whether or not the IASB may in some ways see itself more as what I'm sort of euphemistically calling a management accountability standards board rather than an accounting standards board. Look, I am playing devil's advocate a little in terms of my input, but I do think there is I honestly think the discussion paper, that section, paragraph 216 through to 218, that dismisses to a certain extent the role of comparability in acknowledging that every company will tell you something different. That whole section there is what really alerted me to what I feel is a degree of in what's being said as a set of disclosure requirements, which is very different from the way we can carefully understand why the decision, for example, around a critical issue, which is how we account subsequently for goodwill that's recognised, how that ties back to the concepts that are supposed to underlie the development of accounting standards.
Yeah, so I guess the only thing I'd say, I think one of the key roles of financial reporting, one of the key purposes of general purpose financial reports is stewardship. And in terms of what investors are telling us they need in terms of business combinations, and one of the key pieces of information they need in order to be able to hold management to account, that stewardship purpose of financial reporting, is information about the subsequent performance of the acquisition. And so that's the reason why the board is exploring these particular disclosures. I do take the point that business combinations is one significant allocation of capital, but there are other significant allocations of capital, be it major capital expenditure projects, be it a major restructuring, and these disclosures are only focusing on business combinations. But then I guess that's simply because this is a project that's come from the post-implementation review of Ifrs and is looking purely at business combinations and is responding to some specific feedback that the board has had from investors on the information that they think is critical for them to hold management to account on business combinations. But I do take your points.
Am I allowed to just an ad hoc comment I would make is that it's not coming from a finance perspective of, we don't want to deter M&A activity. I mean, the irony in me making some of these criticisms is I would also, readily agree to the claim that Australia has a pretty appalling track record in M&A, particularly as it relates to overseas M&A. Just to take the banking industry as an example that I would cite, has had an extensive history of making overseas acquisitions that look to me like they've been pretty disastrous. But, the accounting requires management to recognise that. I mean, we can argue about how timely or how efficiently that's occurred. But, if you spend X dollars on an acquisition and as a result you recognise X dollars of acquired assets, part of which might include goodwill, the accounting standard requires you to address the fact that that acquisition may in fact have not been successful and the simple measure of success is ultimately whether or not you've paid too much. And if you've paid too much, the accounting standards as they currently stand require you to do something about it. So it's not as though the recognition and measurement principles that are mandatory through the accounting standards don't address this. And on the other hand, there are so many other sources of information out there by which investors, use in addition to financial statements to get a sense of whether or not management is making good or bad investment now. But that's sort of where I'm coming from in this sort of concern.
If I could jump in at this point. No, we really appreciate you taking this devil's advocate role, Stephen, because it really assists. There's a number of things that have come up as you and Tim have been talking, but I want to pick up first on your last point, which began to sound like you thought there were already enough mechanisms for holding management to account. And that might be Australian specific, because you do in your question refer to the fact that there is a robust governance framework. And so if I just divert for a minute, of course, and you and I have talked about this before, you know, it's when the Iasb has to think about requirements, it has to think about multiple jurisdictions which vary in their institutional frameworks. So you have your view that Australia has a governance framework that is operational and doing things, and I comment, you know, well, we have to think about some other situations where it's possibly not so robust. But let's put that to the side. What I heard from your last sort of comment was that you thought that the standards have got the requirements, and then eventually we get to the impairment test. It might be late, but we get there eventually. And also I hear you say that a lot of information is going out to the market anyway, be it through media attention, be it through robust governance, be it whatever mechanism that's outside accounting standards. And so the accounting information is part of that, but there's all these other things in place. So bottom line, do I hear you say that you think actually it's working quite well? If we can do a bit to improve the impairment test as proposed, that's fine, but we don't need to go further. Is that where you're located, your views at the moment?
That would have been that probably, if I have to sort of think about where I'd come down on this, that's probably my view. And that's also driven by my concerns that formalising these disclosures into the financial statements potentially creates, I think, a lot of assurance issues, because, you know, when we require the financial statements to be audited, I think it's going to throw up challenges to the auditor in a way that you know, obviously an auditor is concerned about how management runs the company, and any audit partner would, at least privately, give you a view about how a client is being run. But at the end of the day, they don't have to, in some senses, assure management's interpretation of information related to their own decision making, and I think that I do think that's going to be a challenge.
Mm-hmm. I know Peter Wells' question, but I just want to pick up one other point that Stephen has raised, and that was about I'm just referring back to what Tim said about how we actually arrived at. It was part of a process where the board realised that it was hard, that test was the thing that held management accountable for their acquisitions. I don't think that's Stephen's view, but this is a view that the board came to realise that it was pretty hard to make that impairment test the thing that held management accountable for acquisitions. And that was how we ended up considering the disclosures. Stephen has said today that, you know, they seem ad hoc, not part of a coherent framework. I mean, in defence of staff and board, it's just about responding to investor information needs, being identified in conceptual framework. However, I know there's more Stephen and I could debate on this, but I will stop there. And there are lots of really good points, and the discussion's helpful. I do want to go to Peter Wells' question.
Thanks, Anne.
See. Thanks, Stephen. Kim, is that okay? I'll go to Peter Wells' question.
Yeah, of course.
Peter, I think what you're saying. Yeah. So Peter Wells' question is about the problem of evaluating acquisition performance arises from the recognition of part of the acquisition price as goodwill. And Peter uses the word nebulous, so we know that goodwill is the unidentifiable part. If there was better identification of purchased, e.g. brand name, there would be better appreciation of what was purchased and whether it was performing. Thanks for the question, Peter. And I wanted to pick up on this because it's really an important part of our considerations, even though it appears just in that, what we call section 3. In the last part when I was talking, I said the board has stayed with the position of separate recognition of intangibles. Now, I would assume that Peter, in his question here, is a person who supports that separate recognition of intangibles. And I wanted to touch on that issue because there are some people who feel really strongly about this. And Peter, they don't feel strongly in the way I think you do. And you'll come on the line in a minute and tell us whether have I understood you correctly. I think you're in favour of the separate recognition, putting a dollar value on the brand or the item that's being purchased, as we do now under the present accounting standards. So the board's not proposing a change, but we do recognise for some people, they would really like that changed. They really don't want some of those things separately identified. And the reason that we're told that they don't want that separate recognition is that it's then the treatment that comes subsequently. They have trouble comparing entities that are grown organically and entities that are grown from acquisition because of the amortization of the separately identifiable intangibles. So we do hear for some people that they would like to have that subsumed back into goodwill, which I think is contrary to what you're arguing. The other thing that we heard that was surprising is we thought that the people who'd wanted subsumed back into goodwill was uncertainty and the cost and difficulty of making the measurement of those separately identifiable items. But we didn't get, in some of the early consultation, we didn't hear that. People didn't say that to us, so that was a surprise. So I think if I could just ask for Peter, if you want to challenge me on any of those things or want to add anything more on this point, and then I'll go to Tim, and if Tim wants to add. But I think it's an important issue. It doesn't take a lot of space in the discussion paper, but it's still an important part of what we're thinking.
I most definitely do advocate the recognition of identifiable intangible assets when they're purchased. And I think that if you just lump it into goodwill, then you run the risk of it becoming very indistinct. Impairment testing becomes much more difficult because you're subject to shielding from other goodwill, which might be internally generated, which mightn't be internally generated. Maybe it's from other assets, who knows? So I very much do advocate recognising identifiable intangible assets. And at the end of the day, if you pay $100 million for some brands, then at the end of the day, that should be on the balance sheet and it should be recognized and subject to verification from time to time, and impairment testing as necessary. I think the issue which of just lumping it back into goodwill, then it just makes goodwill much more problematic because you have recycling, regeneration, shielding, all the problems which come with goodwill, which wouldn't arise in the same way if it was a properly identifiable intangible asset. And so it cleans up a lot of those issues. And if you buy a brand and you then trash it, or if you decide to kill it off, then it's quite clear what has to be written off or impaired. So I think it simplifies a lot of issues if you go down that path. And there is some evidence that this worked in Australia. And if you want to force companies to recognise it, Stephen's going to jump up and down and scream at this one, I know. Just start them, and all of a sudden people will love identifiable and tangible assets.
Good. Thank you for sharing those thoughts. Tim, do you have anything to add, or would you like us to move on?
No, I didn't have anything to add, but just actually the only thing I would add is to Peter's and the very first question that we answered. Peter just was clarifying that in terms of the disclosures I was referring to, they only apply to cash generating units that contain goodwill or live assets, which is true, and that is the case. And I guess that's my focus is on that, I guess, because in terms of what we're looking at here is looking at goodwill and the Goodwill Impairment test, but rather than other assets. The board did, when it was looking at this project and looking at disclosures, it did think about whether it wanted to do a full review of the IS 36 disclosures and just not to do that and to focus on the disclosures that we've talked through today. So, I mean, certainly, Peter, to the extent it's an important issue, then I think that's an issue that can be raised through the discussion paper, because there's the opportunity to raise other issues through the discussion paper associated with impairment testing. The avenue for that, but I just thought I'd just clarify that.
Thank you.
Yes, I think we can move on to the next session.
Thanks, Tim.
Oh, that's me as well. So if we go to slide 8, yes, thanks. So we'll now discuss the other main topic in the discussion paper, which is the subsequent accounting for goodwill. And there's 2 key pieces of feedback, which were that stakeholders said that impairment losses were recognised too late. Investors have often reflected reductions in their valuations long before impairment losses are recognised by companies. And secondly, stakeholders said that the impairment test is costly and complex. Now, in response to this feedback, the Iasb explored whether it could make the impairment test more effective at recognising impairment losses on acquired goodwill on a more timely basis. And we'll take a look at the Iasb's work in that area first, and then we'll look at the Iasb's preliminary views on whether to reintroduce amortization and on its efforts to reduce cost and complexity of the test. So the Iasb identified 2 possible reasons for the too late issue, which is cash flow forecasts that are too optimistic and shielding. Now, on the first issue, IAS 36 requires management to use forecasts that are reasonable and supportable, and to assess the reasonableness of assumptions by examining the causes of differences between past forecasts and actual cash flows, and to assess the reasonableness of those past forecasts. In addition, companies are required to disclose information about the assumptions used to provide investors with information to assess the reliability of impairment tests. The IASB's preliminary view is that if forecasts are too optimistic, this is more of an implementation issue that's better dealt with by auditors and regulators than by standard setting. Now, slide 9 explains the second issue, which can lead to impairment losses on goodwill not being recognised when stakeholders might think they should be, which is shielding. Can we move on one more slide, please? Before we start, an important point to mention here is that the impairment test is not a direct test of goodwill. Goodwill does not generate cash flows on its own. It can only generate cash flows in combination with groups of other assets, and so it can be tested for impairment only with those other assets. Goodwill is therefore tested for impairment in a cash-generating unit or groups of cash-generating units. And hence the test is an indirect test, since goodwill cannot be measured directly. The unit of account for the test is the cash-generating unit. So this slide provides a simple illustration of the shielding issue. And on the left-hand side of the slide is acquired business, and something's not turned out as expected. And an impairment loss would be recognised if the acquired business was tested in isolation. However, in most cases, the acquired business is integrated with some other part of the acquirer's business, often to achieve synergies management expected from the business combination. And in this example, the acquired business is integrated into one of the acquirer's existing businesses, and there's significant headroom in that existing business. Its recoverable amount exceeds the carrying amount of its recognised assets. And that may be from internally generated goodwill that's not been recognised, or unrecognised intangibles, or simply because the fair values of the recognised assets are higher than their carrying amounts. Now, because in this example the combined business is tested for impairment as a cash-generating unit, no impairment loss is recognised, since, as shown by the right-hand side of the slide, the combined recoverable amount exceeds the combined carrying amount of the assets of the combined business. The headroom of the existing business is shielding the acquired goodwill from impairment. Hence, this simple example illustrates a too late issue. Shielding occurs in the current impairment test because the reduction in value is first absorbed by the unrecognised headroom. An impairment loss is recognised on the acquired goodwill only if all of that headroom has been used up. So moving on to slide 10, the IASB looked at an approach to reduce the shielding effect, incorporating the headroom into the impairment test. This approach would have compared the recoverable amount to the carrying amount of the recognised assets, plus the previous impairment to the value of the combined business. Any impairment that results, basically any reduction in the headroom since the previous test, still needs to be allocated between the acquired goodwill and the unrecognised headroom. However, the approach attempted to allocate at least some of the reduction to the acquired goodwill, whereas in the current test it's first allocated to the unrecognised headroom. However, any allocation would still be imperfect because it's not possible to tell how much of the reduction relates to the acquired goodwill and how much of the reduction relates to the unrecognised headroom, since goodwill is not directly measurable. In addition, the approach would be costly. So the Iasb's preliminary view is that it's not feasible to design a different impairment test that's significantly more effective than the current impairment test in IAS 36 at a reasonable cost. The Iasb accepts the test is not perfect because goodwill has to be tested with other assets. Some degree of shielding will likely always occur. The test will not always provide a signal of how well the business combination is performing, but this does not mean the test has failed, as some people say. And although cash flow forecasts will always be judgmental, applied well, the test should meet its objective of ensuring that the carrying amount of the cash generating unit as a whole is recoverable. And the disclosures proposed on subsequent performance that we went through earlier should provide better information about the performance of business combination impairment tests can. And in fact, providing such information is not the purpose of the impairment test. So if we can move on to the next slide, please. So in the post-implementation review, several stakeholders said that the Iasb should reconsider amortization of goodwill. And since amortization provides a simple mechanism that does target the goodwill directly, the Iasb explored whether amortization of goodwill should be reintroduced. And this slide lists some of the arguments for amortization and some of the arguments for the impairment-only approach that stakeholders put forward. And the discussion paper contains a fuller discussion of the arguments for both approaches. And firstly, just a point of clarification. When we're talking about the reintroduction of amortization, this would be with an impairment test as well. So those stakeholders in favour of amortization argue that the post-implementation review has demonstrated that the impairment test is not as rigorous as the Iasb expected and does not provide as much information as the Iasb expected. Because of shielding, carrying amounts of goodwill can be overstated, and so the test does not hold management to account, and they argue that an amortization expense in the income statement would hold management to account, reporting companies as profitable only if they generate enough profit to cover that expense. Some argue that goodwill is a wasting asset, and amortization is the only way to show the consumption of that goodwill, and to prevent internally generated goodwill being recognised in the place of acquired goodwill as it's consumed. Although it's hard to estimate the useful life of goodwill, some argue this is no harder to estimate than for other assets. And some argue that amortization takes pressure off the impairment test and ultimately reduces the cost of performing the test. On the other hand, stakeholders in favour of the impairment-only approach argue that the impairment test provides more useful information than an arbitrary amortization expense. Although often only confirmatory, they say it's still more useful than an amortization expense that most investors would ignore. And unexpected impairment losses do occur and can have a significant effect on a company's share price. They argue that the impairment test is working as expected. The objective of the impairment test is to ensure the combined carrying amount of cash generating units containing goodwill is not higher than their combined recoverable amount. If applied well, the test meets that objective. Also, when developing IFRS 3, the Iasb was aware of shielding, but concluded then that the test was rigorous. Some argue that goodwill is not a wasting asset with a determinable finite life. Companies acquire businesses with an expectation that the acquired goodwill is maintained indefinitely. And some argue that even if goodwill is amortized, an impairment test would still be required, and amortization would therefore not significantly reduce cost. So if we can move on. The Iasb's preliminary view that it should retain the impairment-only approach was by a narrow majority. The Iasb was, like stakeholders, quite split on this topic. However, this preliminary view reflects the majority view that there's no compelling evidence changing back to an amortization model would be a significant improvement. No, this isn't simply about which model is better, but whether there is compelling evidence that a change is needed. Given the narrow vote, the Iasb welcomes feedback on this topic from stakeholders. However, just repeating well-known arguments will not necessarily move the debate forward. Instead, the Iasb welcomes feedback that provides new evidence or arguments, or perhaps reasons why previous arguments are now more relevant. So if we can move to slide 13, please. So the other feedback from stakeholders during the post-implementation review was that the impairment test is costly and complex to perform. Hence, the Iasb considered whether there were ways of reducing the cost of performing the impairment test without significantly impacting its robustness, and this is discussed on this slide. One of the reasons given for the cost of the test by companies is the requirement to perform the test even when there's no indication of impairment. The Iasb's preliminary view is that it should remove the requirement to perform a quantitative test annually. However, companies would still need to assess at each reporting date whether there is an impairment, and if such is the case, the company would have to perform the quantitative test. This change should reduce costs for companies. However, there are mixed views on the extent of this reduction. There's also mixed views on the impact this would have on the robustness of the test. Some believe this introduces further judgment into the test, and not performing the test regularly could result in a decline in the expertise with which companies perform the test. Some also believe an indicator-based test should be reintroduced when amortization is reintroduced. This was another preliminary review where the Iasb's majority was narrow. The majority, however, considered the reduction in costs significant, which would help offset some of the costs of providing the new disclosures, for example, and the reduction in the robustness of the test marginal. Performing the test when there is no indication of impairment is unlikely to identify material impairment and would provide little information to investors. And performing the test every year cannot solve the shielding issue, for example. The Iasb's preliminary view is that it should also extend this change to intangible assets with indefinite useful lives and intangible assets not yet available for use. These assets are also currently subject to an annual quantitative impairment test. The Iasb also considers some simplifications to how value in use is estimated, which could in turn improve the impairment test. Currently, IAS 36 prohibits the inclusion of cash flows from an uncommitted restructuring or from enhancements or improvements to assets in the cash flow forecasts companies use to estimate value in use. And stakeholders have said excluding those cash flows can be difficult, particularly determining which cash flows relate to maintenance versus expansionary capital expenditure. As well as reducing costs, removing this restriction could make the test easier to understand. Where an asset or cash generating unit contains the current potential to be enhanced or restructured, that would be reflected in the asset's fair value. If that potential is also available to the owner of the asset, it's logical that it's reflected in its value in use as well. However, there are concerns this change could increase the risk of cash flow forecasts that are too optimistic, and the Iasb did consider whether to set a threshold for including these cash flows in value in use estimates or to require additional disclosures. However, the Iasb considered the requirements in IAS 36 regarding reasonable and supportable assumptions that already apply to the other cash flows in value in use estimates, provide sufficient discipline over these cash flows as well. Thus, the Iasb's preliminary view is that it should remove the restriction on including these cash flows in estimates of value in use without any additional threshold or disclosures. Stakeholders also commented that the use of pre-tax cash flows and a pre-tax discount rate to estimate value in use did not reflect how such estimates are performed in practice, generally being estimated on a post-tax basis, and that pre-tax discount rates are not observable. Hence, allowing value in use to be estimated using post-tax cash flows and post-tax discount rates, which is the Iasb's preliminary view, would make the test easier to understand and provide investors with more useful information, where post-tax discount rates are disclosed rather than pre-tax discount rates. Again, we'll now open the session up for your comments and questions on the Iasb's preliminary views on this part of the discussion paper, and for any academic research you're aware of that is relevant to this part of the discussion paper.
Thanks, Tim. We've got a couple of questions. coming through. So I might, Anne seems to be having some technical difficulties, so I might throw to you first, if that's okay. So we've got a question here from Peter again, and Peter's question relates to the determination of impairment of poorly defined goodwill is always going to be problematic. So this is picking up, I guess, on part of Peter's earlier point. And then he's asking what are the benefits and the value, and indefinite life intangible assets, it's possibly less relevant. So Tim, question without too long to think about it, just wondered if we could get your thoughts, please.
Is Peter there, actually? Maybe, Peter, do you want to just explain the question again?
Well, what I'm getting at here is that the goodwill is a very vague asset. And if it's a vague asset, it's very difficult to work out what might be the value attributable to it, or what are the benefits which might be attributable to it. And it's very difficult to rebut any presumption of a requirement to impairment testing. Whereas if it was a specifically identified intangible asset, brand names, it's very quickly demonstrable that we purchased 4 brand names, their sales are holding up, so therefore there's a reasonably rebuttable presumption they're still valuable, and we don't need to do an impairment test on those brand names. Or alternatively, we've retained 80% of the customers that we've purchased when we acquired this company, so therefore we think the customer lists are still of value. So very well-defined asset, it's much easier to ascribe what is the value of that asset and to develop some very quick metrics to work out whether the value of those assets have been maintained. So it's really just going back to the same thing. When you have a very poorly defined asset, goodwill, it's very hard to evaluate how that goodwill is performing, and that has an issue that we talked about previously, but it also has flow-through issues here in terms of the determination of impairment. And then you get the problems of regeneration or shielding, etc., etc.
Yeah, so are you, from that, are you suggesting that the board shouldn't go down an indicator approach because it will be difficult to identify sort of robust triggers and indicators because that goodwill is poorly defined and is always going to be, I think, sort of where you're heading with that comment?
Yes.
Yes.
Basically, I'm an advocate for identifiable intangible assets. If you spend $100 million on something, put it on the balance sheet.
Yeah, so I mean, in terms of the indicators, and other stakeholders have questioned the indicators as well, and whether it is reliant on a robust set of the board has yet to discuss the actual indicators it would propose and to review what's in IAS 36 at the moment and whether it needs to amend the indicators for a goodwill impairment sort of indicator assessment. And that's something that the board will do in the second phase of the project if once the board has assessed the comment letters and the comments on an indicator-based test, and if there's support for that and the board decides to pursue this further, then in the second phase it will look at the indicators and consider whether there needs to be some changes to IAS 36 for that. You're right, it does need a robust set of indicators. Now, whether I think you're questioning whether a robust set of indicators could be developed, and that's something the board will obviously need to think about. I mean, what some stakeholders have suggested is that the disclosures that we talked about on subsequent performance could be an indicator, given that if acquisition is not performing well, it's not meeting its objectives, it's missing its targets, and that's being disclosed, that could be an indicator of impairment. And I guess in terms of goodwill, you're right. It is sometimes difficult to understand exactly what is in goodwill. It can only generate cash flows in combination with other assets, and so would be looked at in combination with those other assets. And so the whole assessment would be based on whether there's indications of impairment for that whole set of assets. And that's something, as I say, the board will look in. But I sort of hear your reservations about whether you think the board will be able to find a suitably robust set of indicators.
Thanks very much, Tim. Now we've got another question here, which I'm hoping you can help us with. So this question relates to situations, I guess, where an entity or a group's balance sheet comprises goodwill, which is a significantly higher or significantly larger proportion in relation to total assets. So, for example, maybe 75% of your total assets. And I guess the question here is, what if the IASB considers a limit or a threshold to the value of goodwill? So, for example, it could only be 60% of total assets or something like that. And then Away goes on to ask some further information. So I might, Tim, throw to you, but I'll also take them off mute so that they can provide some further context.
Yeah, I mean, I think my initial reaction would be, you can see Anne rejoining as well. My initial reaction would be, well, that does sound a bit rule-based, and I think the questionnaire is actually suggesting that anyway, that yes, it may be a little bit rule-based. I think the difficulty would then be the argument about, well, what is the right threshold? And I don't think necessarily that the board wants to get into what is the right amount of goodwill that companies should have on their balance sheets in comparison to their net assets. So I'm not sure that would be a particular avenue that the board would want to go down. I mean, we'll talk about in a moment, but actually coincidentally it sort of does relate a little bit to the preliminary views that we'll talk about in a moment, which is a presentation on the face of the balance sheet of the amount of total equity excluding goodwill. And the purpose of that is really to sort of highlight sort of the issue being suggested here, highlight those companies that do have a very large portion of their equity, and sometimes even more than their equity, that is constituted by a goodwill balance, and it might provide a useful flag to investors on that. But as I say, in terms of actually setting a particular threshold, I'm not sure that's a route that the board would necessarily want to go down, because it might be difficult to determine what's the right threshold, and is there a different threshold for different industries, and so on and so forth. So that would be my thought.
Thank you, Tim. Actually, within my question, I actually mentioned, yes, it is. I acknowledge that it is definitely easy to specify that in rule-based framework than sectoral framework, for sure. So I understand it's more, like there are instances where, startup companies are acquiring another small business, or, and having a sort of significantly, they rely on the goodwill number. Yes, obviously they're all judgment counts, what are their forecasts, what other qualitative plus quantitative factors look like. So, but I think my question was around there when, a company or a group specifically relying on a goodwill number to, I think to attract investors in future. So, yeah, I mean, there are definitely other practical considerations. So that was just a thought, basically.
Yeah, and I guess the other thing I would say is, if management believe that, and if this goodwill is on the balance sheet, then management have got forecasts that just and believe that there are economic benefits that goodwill and the assets it's combined with will generate, and it would therefore seem a little bit harsh that they might have to impair if they reach a certain percentage. They might have to impair that goodwill if, generally speaking, management believe that it will generate future cash flows that support that value, which is in essence what the impairment test of cash generating units containing goodwill is. It's ensuring that there is sufficient cash flows to recover the carrying amount of that goodwill plus the assets it's associated with.
I agree.
Thanks, Tim. And we've got a question here from Brian. Well, it's more of an observation. So Brian's observation is around the implication of the last two questions that we've just talked about. And he's quoting some views of Ray Chambers and the, I guess, approach to simply writing off goodwill and acquisition rather than recognising it on the balance sheet. So Anne?
Thanks, Kim. As Brian said, he's just making an observation, and knowing Brian, he's probably got his stirring the pot a bit here. But I did want to respond because it has come up about this simply writing off goodwill, and we know that was a practice. We all know that it was a practice prior to Iasb standards, and say in the UK, for example, where it was directly written off. I think the thing on this is that there are some investors who would like goodwill to be a number and not even amortized, and not even, that the amount spent is always visible, so that the goodwill doesn't get reduced, and they can always tell. So not even, yes, impairment has some confirmatory value, but still being able to see the total amount of the goodwill as part of recognising the acquisition and what it cost and what the performance has been like. So moving to a write-off model would mean that information disappeared. So quite aside from some other issues that would come up, like that would mean that we don't think it's an asset, which is not the way many board members interpret conceptual framework, because many board members see it, they do see it. But that gets into another area of debate, doesn't it? Because there are some people that don't see goodwill as an asset, they see it as a residual. However, if you're of the camp that you see goodwill as an asset, then being on the balance sheet makes sense rather than being written off against equity. The other bit of your observation that you don't mention is that the whole political ramifications that would exist was written directly off against equity, because we talk sometimes about whether accounting is related to behavioural change or not. Can you imagine behavioural change that would be accompanying a change in accounting standards that wrote off directly against equity? Yeah, so I'll stop there and pass to Tim. Yeah, thanks. Oh, Brian, did you want to come in on this, or have I said enough?
Well, you probably said enough, but you do know me too well. I am slightly being facetious with this. But I guess you did ask for us to think outside the square a little bit, and we could go back to the old rectangles. I guess if there was a threat of writing it off, it might indeed encourage people to be a bit more conscious about identifying the identifiable intangibles. But yeah, no, your points are well taken.
Thanks, Brian.
Thanks, Anne. So we've got another question here, and Tim, I'll pass this one to you. And it follows on from some of the earlier discussion, but Peter's just asking, why would we stop at subtracting goodwill from equity in the balance sheet as an example? Why wouldn't we then continue on and subtract deferred tax assets, trailing commissions and revenue, that sort of thing? So Tim, I'll pass that one to you, please.
Yeah, I mean, the board actually did think about it slightly wider as well. The board did consider whether it should include some or all intangible assets in that measure as well, getting near to sort of like a tangible net worth type disclosure almost. But decided just to focus on goodwill because it is different in nature to other assets. It can't be separated from the business. It can't generate cash flows on its own, for example. And again, I mean, this is a project that's dealing with post-implementation review of Ifrs 3, and its focus is business combinations, and that's specifically why it's looking at goodwill here, rather than some maybe other assets that could be suggested. So that's the reason why the focus is on goodwill, and it was just something that the board thought might be useful as a useful flag to investors to show how much company's equity, what proportion of it is made up by goodwill, is supported by goodwill.
Thanks, Tim. So we don't have any more questions at this stage. So I'd wondered whether you were happy to move on, or whether there were any other thoughts that you would like to share at this point. I'm in your hands.
Yeah, I would ask if our participants today have got any comments about the impairment, the indicator, whether they've observed anything in the US research, where of course they do have a version. It's not the same as what we're talking about, but they have got some experience with an indicator approach to impairment. I don't know if anybody in the audience is familiar with that research or would like to comment. While people are thinking, I could talk about what we've heard, staff and board have heard on this topic, because we thought that would be a relief for people, whereas others have said no, it's actually better to be doing it every year. You've got systems in place, so once the systems are in place, it doesn't incur so much cost, and it's better to keep the knowledge of how to do it. And so some people that we might have expected to favour an impairment, an indicator approach, didn't support indicator approach for those reasons that I've just said.
Yeah, the other thing I might add to that, in terms of some of the feedback that we do get on that, in terms of the robustness and the concern over the robustness, the indicator approach is, sometimes we do hear people say, well, they think it's more judgmental in the indicator-based assessment. And it will give companies more opportunity to avoid impairments, and sometimes it might be harder for auditors to challenge an indicator-based test. I think what the board would like to hear from stakeholders who have that type of view is some examples of additional judgment, and also why it is harder for auditors to challenge. If I just use a very simple example, if I'm doing an indicator-based assessment and my competitor launches a new product and my market share is just starting to be negatively impacted by that, I might gather some evidence together, talk to my marketing department, my sales department, look at maybe some history of when that competitor's launched other products before and what that's done to my market share. And I might, based on that, make the judgment that I don't think it's going to be significant, therefore I don't think there's an indication of impairment. If we're in today's environment and I have to do a quantitative impairment test, well, I need to make some judgments about the assumptions that I'm going to use in that quantitative impairment test. And I may have assumptions around my sales volumes and my sales prices. Now, I'm going to have to make the same judgment about my competitor's new product launch when I'm making those assumptions, and to determine whether there's going to be a significant impact on my sales volumes and my sales prices. I'm going to use the same evidence. I'm going to make the same judgment that I don't think is going to have a significant impact, and I'm going to reflect that in the assumptions that I then come up with for my quantitative impairment test. So to me, the judgment is the same judgment. It's just being done in a different way. And the evidence that I use to make that judgment is the same. So I think the board will be interested to hear from stakeholders where the additional judgment does arrive, or why it might be harder for auditors to challenge.
Thanks, Tim. Anne, I'll throw this to you. We've had another comment come through from Peter. So it's just in relation to if the Iasb were to go down the indicator approach, then the indicators, so target and actual, would need to be disclosed. And this sort of comes back to the very first question that Peter asked at the beginning of this session around, is this information necessary for transparency in financial statements and things like that? So Anne.
Thanks, Kim. Yes, point taken, Peter. We've put out in the discussion paper the idea to see what people have got to say about an indicator approach. We would be, board would need to do more work on how that would work, and more work on the actual indicators. We haven't gone there yet, but again, that thinking would need to happen. And then the thinking also about disclosure. I think the question you raised also makes me think about the point Stephen has made, that the market mechanisms that are promoting disclosure, or alternatively there are forces discouraging disclosure. We do have indicators of impairment in IAS 36 as it stands now. That would be a starting point for us, but more. We would need to develop that further. Yeah. Okay. Perhaps I might ask if there are any other respondents who'd like to comment on the other thing that Tim spoke about, which was the simplifying the value in use estimates in the impairment test. One of the ideas was that entities could include cash flows in relation to they could consider future changes when they're making their cash flow estimates. Now, we hear different views. For some people, they say that yeah, it'd be very useful because the information is already available internally and it gives a better estimate of value in use. For other people, they say that there'll be too much subjectivity coming in. So I don't know if anybody's got research that has touched on this. I mean, in general, there's the research that inform about the subjectivity of judgments, and also research about information that is that are projections. But I don't know if there's anything else that's specific to point out to us at this stage.
And I can see that Michael Bradbury has his hand up. So I'm just going to take him off mute and we'll see what he has. Thanks.
Great. Hi, Mike.
Can you hear me now?
Yes, we can, Mike.
Isn't that, you know, trying to build in future changes in your cash flows and things like that, isn't that a bit of a slippery slope? Because if I sell a car now, if I sell, you know, I'm sorry, Toyota or whatever it isn't, every time I sell a new car, I know that means 10% chance that the same person will come back in 5 years' time and buy another one. So can I build that in? Is that a current asset or is it a future asset? You know, and how do you decide what the difference is? So yeah, I just think it's worth going down there.
Okay, thanks, Mike. Too much of a slippery slope. Don't go there.
Yep.
Yeah, it was part of our. We tried to look at a package of things, and you know, if on the one hand we're requiring more disclosures on something, could we then complement? You know, could we put a whole package, which is what we're looking at in the discussion paper, whole package of measures that together would achieve things that people are looking for, both beneficial information for investors, but also cost reductions for preparers. However, when we take out the pieces separately, like we are just doing now in terms of those cash flow projections, you know, there are those that take your view, Mike, that it's too subjective, too dangerous to go there. Okay, Tim, I might go back to you. No more questions that I can see coming through.
Oh, sorry, Anne, we've just had one more question come through. So I'm not sure, Tim or Anne, who would like to answer this, but this is, I guess, just building on Mike's point and your comment, Anne. So just in relation to the annual impairment tests, so judgment and estimation obviously is a continuous improvement process. And so undertaking that process every year obviously improves the robustness. So I'm not sure, Anne, whether you'd like to take this question or respond to it.
Yes, so Awas has confirmed that he is of the view, he or she is of the view that that there are benefits in doing it on an annual basis. Okay,
yes.
Thank you for that. I would just don't know if there's any other research that people have. If you do, can you point that out to us if there's anything that can help us on this business of an indicator impairment? I might just ask Awas if he'd like to come on the line, if he's got any evidence. He's given us, he shared his view, but perhaps he might have some evidence behind it. Awas, would you like to comment?
Not a specific research or
no, okay.
But you know, I've worked on assignments even sort of involving US gaps and you know, some other local gaps, and it's you know, wherever, you know, goodwill accounted as an asset, and especially being conceptual framework, again, it comes back to, you know, when you can't specify the rules, there are actually tens of, you know, indicators. There are often a lot more important qualitative factors than actually quantitative factors. So I think it comes back to the essence of, you know, this process itself. So if we want to keep this as a highly judgmental and estimated area, so I think this process is definitely have to be done annually, unless, you know, we say only a specific indicators have to be reviewed, in which case, you know, you can always shortlist and say, yes, you know, these 3 or 4 indicators do not point us to, you know, impairment, hence, you know, no need to sort of carry out that exercise. So I would say, as you mentioned, it yes, by you know, maintaining this annual process.
Thank you. Thanks for sharing that experience that you've had. Okay, I think I'd hand back to Kim now.
So, and just before we move on, Mike Bradbury's raised his hand again, so I'll just bring him off mute.
Good.
Hi, Anne.
Hi, Mike.
With regard to sort of annual impairment again, this is part of the experience, but one of the things, if you're doing it annually, is you can actually back test last year's one. Right, so you can actually get a much more, it's not only you gain experience doing it, but you're actually testing on what you're doing as well. So it's part of the same thing, I guess, but it's not a different take on it.
Yeah, that's good point. Thanks, Mike.
Yeah, in fact, I just add to that, I mean, some people have said that actually that's one of the reasons why it might be harder for auditors to challenge indicator assessments, because they haven't got last year's impairment tests and results to sort of compare to and to think about. And if an impairment test hasn't been done for a quantitative impairment test hasn't been done for a number of years, it might make it harder then to challenge. I mean, there is, and that sort of comes back to also, you know, companies may get out of it from doing these tests. I think what I would also say that, though, is that in an indicator-based environment, if that was the case, then there's obviously nothing stopping a company actually performing quantitative tests at some point in time to sort of calibrate its indicator assessments. So not every year, obviously, but every so often performing the quantitative test, if it hasn't done it for a certain number of years, just to calibrate its indicator assessments, because, you know, things move on. Certain assumptions suddenly become, you know, impairment tests might become more sensitive to certain assumptions. And sometimes you only find that out through doing that calibration exercise. So there may well have to be a need for that type of calibration exercise.
Okay, thanks very much. So We've got no other questions coming through, so if it's okay with you, and I might suggest that we move on to slide 14.
Yes, that's very good for me. Thank you. Okay, we've just got 2 more slides to finish up here. So 2 more topics. So slide 14. The Iasb has a preliminary view that companies should present on the statement of financial position the amount of total equity excluding goodwill. The board's view is that such amount could be a useful flag to investors to highlight those companies for which goodwill is a significant portion of their total equity. And some of our questions and discussion today have already touched on this. The Iasb did consider whether the amount should exclude some or all of intangible assets as well as goodwill, but in its view, goodwill is sufficiently different to other assets that the focus should just be on goodwill. Presenting the amount as an integral subtotal with all balance sheet formats may not be possible, and therefore the amount would need to be presented as a freestanding amount in the statement of financial position. The Iasb also considered whether entities should subsume some intangible assets within goodwill and not recognise them separately in a business combination. And that's what we were just talking about with my interactions with Peter Wells and others. The Iasb had feedback from stakeholders that questioned whether the separate recognition of some identifiable intangible assets was useful, where those intangible assets are difficult to value reliably, and where distinguishing some intangible assets is complex and subjective. Some stakeholders also questioned why intangible assets are recognised separately in a business combination, but similar internally generated intangible assets are not recognised. But as is often the case, stakeholders' views are mixed, and some said that separate recognition does provide useful information about what a company paid for, and separately recognising intangible assets with finite lives rather than subsuming them in goodwill is more useful. Goodwill, of course, not being amortised. So the Iasb's preliminary view is that there's no compelling reason to change the recognition criteria for identifiable intangible assets in a business combination, given these mixed views. Considering the concerns of those investors who want to align the accounting treatments for acquired and internally generated intangible assets is beyond the scope of this particular project, but we do encourage stakeholders who Iasb to consider a broader project on intangible assets to respond to us via our upcoming agenda consultation. So 2021 will see us reaching out to you on the agenda consultation, and we'll be reaching out with suggestions of a number of projects that we've heard that people think the Iasb should be addressing. Intangible assets is one of those. So please give us your feedback and let us make the, prioritise the things that you think we should be working on. Slide 15, please, Kim. And this is our concluding slide. So this slide captures a point that I made earlier about this being a balanced package with many elements to it. So slide 15 summarises the Iasb's preliminary view and how they line up against the project's objective. And the Iasb considers the preliminary views as a package of views that interconnect rather than individual preliminary views considered in isolation. So we do ask you, our stakeholders, to consider your responses to the preliminary views in this way as well. So that is to consider the interactions between the different preliminary views. Overall, the Iasb has provided preliminary views which, in the Iasb's view, would provide better information to users of financial statements on business combinations and help hold management to account for acquisition decisions by both the disclosures and the subsequent accounting for goodwill, and also provide some cost relief to preparers so that the package in its total provides a reasonable balance between costs and benefits. So what we'd like to do is once again open up for questions on the preliminary reviews, any of the things we've talked about, and also these last couple of comments. Thank you.
Thanks, Anne. Tim, we've got some feedback here from Mike Bradbury once again. So his feedback is just in relation to if investors can work out impairment in advance of accounting, so this concept that the market is running ahead of the lodgement and reporting of financial statements, then he's suggesting here that deducting goodwill from equity wouldn't necessarily be news because it's something the market's already expecting. He has suggested here, though, that it might be useful if there's an immediate write-off, as analysts who want to can then back it out. So Tim, just give you an opportunity to respond if you'd like, please.
Yeah, I mean, as we talked about before, the board see this as a useful flag. I think it could be a useful flag to investors. I mean, it has had some mixed feedback on this particular proposal. I mean, some say it's relatively easy for an investor to calculate this. But it might be useful for those investors, you know, the sort of automated investors that sort of are algorithm based and pick up certain information from financial statements, and it might be something that's useful for that type of investor. And in terms of your point on direct write-off, I mean, I think we talked about that a little bit earlier and talked about that again. I think the board, when it did think about direct write-off, because it did think about it earlier on in the project, it decided not to pursue that because it wasn't consistent with the board's view that goodwill is an asset. It represents your economic benefits, and would be inconsistent with the economics of the transaction because management believe they have paid for something and paid for economic benefits. Mike, I didn't know whether there was anything further you wanted to add.
No, that's fine. It was more of a comment than a question, but yeah, thanks.
Thanks, Tim. We do have some more time allowed for questions. So for those of you that remain on the line, if you wanted to raise anything, feel free to raise your hand or type a question into the chat function. I can see here that Wei has raised his hand once again, so I will take him off mute and allow him to provide his feedback, and then for either Tim or Anne for yourselves to respond.
Just a comment and perhaps a question. So this present total equity excluding goodwill, the sort of, you know, in relation to my earlier question where I asked about, you know, considering setting a threshold on goodwill value as in proportion to total. So I think it addresses another way, you know, where, you know, investors want, if we exclude goodwill, what will be our equity? So that's, in that regard, is our board considering also to make a flow here in detail, explaining that presentation and how it impacts sort of impacts on the financial report?
So the board hasn't discussed any disclosure associated with it. It is just simply aimed to be a presentation on the face of the balance sheet. You know, once the board has considered the feedback on this particular proposal, and if it decides to take it maybe think about you know, the disc with all of its preliminary reviews, in fact, and it might think that there's a need for some disclosures here based on some of the feedback that it's heard. That's something that, you know, the board may decide to do. But the preliminary review as it stands at the moment is just simply to present this on the face of the balance sheet.
Yep, thank you.
The participants to put up some questions and give us some views on what they think about the importance of staying converged with US GAAP. The requirements of IFRS 3 and the requirements in relation to goodwill largely converge with US GAAP. FASB has a project, and FASB is actively considering the issue of goodwill amortization. So do our participants today have any questions or comments about that could help board and staff regarding the question of how important it is that the IASB and the FASB stay converged, because there is a possibility that the IASB will go one way and the FASB will go a different amortization of goodwill. Okay, so something's in the chat line, not the Q&A, and the comment has come through from Anna. And Anna says, I generally have the view that convergence is useful, but conclusions shouldn't be changed just to converge for the sake of convergence. So Anna, thank you for your comment there. Yes, I take that to mean there needs to be a good process of reasoning by staff and boards in relation to their preferred position. And as we've said in our session today, the board's preliminary view is that they haven't been given enough evidence to suggest that they should change the current position.
Yeah, I would, yeah, is basically what I'm saying. And I say that with I guess a suspension of my view around amortization of goodwill, where I was also going to actually make a comment around that, in that while I agree with the board's reservations around moving away from the impairment only model to an amortization model, primarily around the idea that, to be honest, for me, primarily it would be around the idea of how would you estimate an appropriate useful life for that combination, and therefore it wouldn't actually, that would be a bigger almost judgment than identifying impairment indicators and then sort of moving to more that model. But I say that in a how do we balance that with the fact that actually the way that I guess the standard is perhaps applied at the moment, where you end up with no impairment, and goodwill falls off the cliff. And which doesn't seem to appropriately reflect the, I guess, decrease in value that would be associated with that goodwill. And I appreciate that that is the whole point of this. And I guess it's just to comment really that I'm not entirely sure how you balance that out. And I do appreciate the around I guess the idea behind adding in an extra step of an impairment assessment rather than an automatic review, like calculation test. But yeah, I guess that was all really, I just wanted to make that comment.
Thanks for that, Anna. Yeah, it is for some stakeholders, this business that you wait and wait and wait for the impairment and then it comes and there's some sort of cliff. That contrasts with the view that we hear from others that say, no, in the end, the system does hold management to account in the sense the impairment will appear. So various views. I will pick up on Peter Wells' comment. It's not a question, it's a comment in the Q&A. Again, made with a smile on his face, that it will create wonderful research opportunities. And many of us have enjoyed our research opportunities investigating differences between IFRS requirements and US GAAP requirements. But as Peter rightly says, it's not a reason for the boards to do that. But I'm just highlighting that it could happen. So we do need to have a good way for the boards for the Iasb to approach this and to think about this and to consult with stakeholders, and hence is why we're bringing it up, because the FASB, they could go a different way.
Perhaps can I just maybe comment on a couple of things Anna said as well, in terms of Anna's perspective on the convergence question. I think when we do hear from stakeholders on that question, that's very similar to what we hear, which is stakeholders say that convergence is important, but it's not critical to the decision making, and they think the board should make decision based on the merits of the evidence, etc., rather than what maybe the FASB might do. So that's very similar. And then in terms of the amortization, returning to amortization, I think that for those that advocate that the board should reintroduce amortization, I think, as we said in the presentation, the board is looking to see whether there's compelling evidence that a change is needed and where change would be a significant improvement. I think the challenge the board, I guess, would give to stakeholders who would reintroduce amortization is, as Anna says, useful life is very, very difficult to estimate. And certainly when the board issued IFRS 3, the board then thought it wasn't possible to estimate it reliably. Therefore, any amortization period and any amortization charge would be arbitrary. And so the question then would be, would an arbitrary reduction in goodwill balance be a significant improvement to the model that we have today? And certainly some stakeholders say that they think that companies would, if amortization was reintroduced, would simply add back the amortization charge in their earnings metrics that they use to report to the market, because they would argue it's not particularly reflective of the economics of their business. And in fact, many investors that we speak to say that they wouldn't find an amortization charge useful and they would ignore it. So again, does that represent a significant improvement to financial reporting compared to the model that we have today? And so that's what the board is asking stakeholders who believe that amortization should be reintroduced, is to explain to the board why they think it would be a significant improvement. That's just things I'd add to Anne's comments there.
Thanks very much, Tim. I can see here Away's got his hand up again, so I'll just take him off mute and allow one of you the opportunity to respond to his comments.
Thank you, Kim. Just a few comments on this convergence and US amortization model. So I agree with others also, like I do not support sort of amortization model, because it just goes against very essence of having the goodwill as in nature of goodwill asset. Having said that, on the flip side, globalization, markets linked, in a way, sort of, US is significant in terms of, driving the markets throughout the world. So convergence is definitely a project, but it does not mean that Iasb has to take the approach of US sort of gaps. It could be other way around also. Again, on the flip side, let's say, just for the argument's sake, if we adopt amortization model, I think, the judgments are anyways involved in even assessing impairment of goodwill as it is now. So, estimating useful life, yes, that is an estimate, and there will be again, judgments will be involved. And the thing is that, like other assets like property, plant, equipment, we do review lives annually. So there is an opportunity that or entity thinks that, that the estimate wasn't right. There is always an opportunity to review those useful lives or any other estimates, around that annually. So if, again, if we adopt that, that's sort of my argument in favor of that, there is again that same process of estimating and judging and then reviewing it annually. So you can fix those errors if you made, having initially thought about some specific useful life of them.
Thanks for that. Does anybody else have any other questions, comments, observations? Okay, there don't seem to be any more questions coming through, Anne and Tim. I'm not sure if there was anything else that you wanted to discuss at this point. We are very close to time, but we still have a few minutes if there was anything else that you wanted to add.
I'd just like to thank everyone for joining us today, and thank you for your participation. And as we said, Tim and I have been saying, it's a very important project for the Iasb, and we welcome your comments and your feedback. But thanks so much for your participation today, and it's always a pleasure to be speaking with you.
Thanks, Anne. So yeah, thanks very much to Anne and Tim for the very useful and comprehensive presentation. And also thanks to all of the attendees. As Anne said, your input and feedback, as always, has been very, very useful. Now, this session has been recorded, and technology permitting, a copy of it will be available on the AASB's YouTube channel. And you'll also receive an email from myself in the next couple of days with a copy of the slides attached. At this point, just re-emphasising, as we've gone through, Tim and Anne have mentioned it a couple of times, but if you've got any research on any of the areas that we've discussed, or you're aware of anything, if you could please make sure to share that with us so that it can be considered as appropriate. That being said, if no one else has any further questions, again, I would thank you for your time and your participation. I hope you enjoy the rest of your day, and thanks very much and goodbye.
Thank you.
Thanks, goodbye. Thank you, Kim. Thank you, AASB.
Thanks very much.
Bye.